Welcome to episode 18 of the Cashflow Connections podcast. The topic for today is investing in notes. This is a really important topic because debt should play a role in any serious real estate investor's portfolio. There are many reasons for this. For example, when structured properly, notes should be very passive. The risk profile should be very unparalleled because of the amount of protection they can provide. The cash flow is extremely non-volatile and predictable. And also, they can be bought and sold as an investment instrument, which allows you a lot of flexibility, including being used as collateral for other investments. In the interview, we discuss all of these topics, and at the end, our guest discusses how to add different tools to your tool belt as an investor. Some of these strategies can really supercharge your ROI. In fact, he goes into the details of turning a 12% return into a 35% return by simply utilizing a combination of notes, leverage, and industry knowledge, which really essentially creates this investment opportunity. Now, just a reminder, if you're listening to these podcasts and you're enjoying the content, please make sure to leave us a review in iTunes. I'm not afraid to say that we are creating some really unique and useful content through the podcast. I say this not because I'm adding a bunch of value, but the guests and the conversations have been absolutely stellar. I've got a lot of positive feedback from listeners saying how much they've learned through the podcast about the commercial real estate market. So if this podcast has helped you in any way, please do us both a favor and leave a review in iTunes. Now that we've established some really solid educational content, I'm interested in getting some more high-profile guests on, and the first thing they do is look at the number of reviews before committing. So go ahead, take 3 minutes right now, and leave a review for the Cashflow Connections Real Estate Podcast in iTunes. It'll be much appreciated. Now let's get straight to the episode. How's it going, everyone? Our guest for today is Matthew Owens, who is the founder of OCG Properties, a company that specializes in equity and cash flowing real estate investments. He graduated from UC Santa Barbara with a bachelor's degree in economics with an emphasis on accounting, earning his CPA license while performing audit and taxation duties at various CPA firms, where he primarily worked with large real estate clients. Since leaving his CPA job in 2006, Matt has purchased and renovated over 600 properties and currently flips more than 10 properties each month. Mostly of these properties are located in the Memphis, Tennessee market. He also has extensive experience helping investors invest in syndications across multiple asset classes. Well, Matt, thanks again for coming on the program today. Really looking forward to this. I know we're going to get into a lot of detail-oriented conversations, so thanks again.
No problem.
Awesome. So before we really jump into the details of this conversation, which is really going to focus on notes, tell us a little bit about your background and how you got started investing in real estate and how you got interested in the space in the first place.
Okay, no problem. So, well, first, thanks for having me on. I enjoy your podcast. I think it adds a substantial amount of value to people. So I appreciate you having me on here to be able to help educate a lot of people on different aspects of real estate investing. So as you know, Hunter, I'm a CPA. I invest in real estate full time. I've been doing so for a little bit over 10 years now. We've flipped over 600 houses. We flip about 10 plus a month right now. We invest in promissory notes, which we do a lot of different strategies associated with promissory notes. We invest in value add multifamilies. We also invest in a lot of different syndications, mobile home parks, self-storage facilities, other commercial, other multifamilies, and an array of different topics. I also have a short-term rental business. And I have offices and a real estate brokerage in Memphis, Tennessee, as well as a management company out in that market. And so I actually got started with some education courses that I took for $16,000 that I had originally told the person to introduce it to me that they were getting ripped off. And then as soon as I saw the courses, I took the courses. And right or wrong, at the wrong timing of the market, I quit my CPA firm job where I was doing tax and audit mostly for real estate clients and decided to jump into real estate full time after that education. It probably gave me a little bit of a false sense of security, thinking I knew what I was doing. But in the beginning, you really don't know anything, until you make those mistakes. I quit my CPA firm job in 2006. So, you can imagine the fun that I had getting punched in the teeth right afterwards with the market corrections and things like that, not realizing what was going on with the market. So, from that perspective, it was probably one of the best learning experiences I've ever gone through. And to be honest, I'd probably quit at the same time again if I had to do it all over again, just because it pushed my business forward tenfold by going through that level of education that early in my real estate career. Since then, like I mentioned, we flipped over 600 houses, but I just jumped ship and was like, look, I'm going to throw myself to the wolves and I'm going to go and try this and make it happen. And, I thought I was, top dog all of a sudden because I was flipping a bunch of houses immediately, not realizing that it was actually the market that was helping me with that and flip that many houses. So I got humbled really quickly, which was probably very good at that time because if you quit your job from working for corporate America and then all of a sudden you're flipping a bunch of houses every month and you're doing really well, you can imagine what that does to your ego initially until you get punched in the teeth and taken back down to reality, which was actually great, like I mentioned. But you get so much level of education from doing that, and that's when I really learned how to raise private capital, which is a key to investing in a multitude of different investment options because you don't have all the money yourself to do this. And so learning how to structure deals, how the paperwork works, how to protect investors every step of the way, I think is the most important aspect of investing in promissory notes, but also investing in real estate as well.
Awesome. Yeah, it's quite a wild ride, and especially just being in the California area. I was going to seminars, starting in about 2010 or so, and I know a lot of people that lost their shirt, and those networking events at the time were quite small because of the fact that people had gotten completely wiped out. So the fact that you were able to weather that storm and continue on and create quite a lucrative career for yourself and for your investors is pretty impressive. So that's definitely a good insight there. Obviously, you're involved in a bunch of different types of real estate, but we do want to focus on notes today for the majority of the conversation. I'm interested to hear, first of all, let's start with, what are notes? How are they typically created? And give us a brief example of kind of a typical single family note.
Okay. So a note is just a loan. That's all it is. What makes it, people refer to it as a note. They refer to it as a promissory note. They refer to it as a deed of trust or trust deed investment. And really all that is, in a note arrangement, you typically have a promissory note, which governs it's like your contract. It governs the interest rate. It governs the collateral involved. It governs the late fees and when the due date and all those types of things inside the note. And then you have ways to secure that note so that you're protected. And personally, I would never advise anybody or invest myself in something that's not collateralized by some sort of asset, especially when you're investing in promissory notes. You can do that in certain instances, but I would, unless you're extremely experienced, make sure that you have collateral. And so the next form of the documentation comes from the collateral involved. So you have a promissory note, and then you have typically, if you're going to secure it by a property, you have a deed of trust or a mortgage that gets secured against that property depending on the state that you're in. So certain states are mortgage states, certain states are trust deed states. And so what that does is that trust deed gets recorded at the recorder's office in the place where the state or the county where the property is located to secure that investor's interest in the property. And so, generally it's just basically a contract that says you loan me this money and I will pay you this amount of money in interest and monthly payments and principal sometimes as part of that payment until the due date of that note occurs or until the note is paid off, depending on what the contract states specifically. So all a promissory note is a loan. And then it gets collateralized by various assets involved. And as we're related to real estate, it gets collateralized with a deed of trust secured against a specific property to protect investors.
Got it. And I understand that seller financing obviously is a really important part of this conversation because some of the notes that are created as a result of seller financing. So just give us a brief description of what seller financing is and why people may take advantage of this structure.
Okay. So there's a multitude of different note strategies that you can deploy. Okay. A lot of people loan money secured against a property to go flip a house. And they'll, like, for example, we borrow funds sometimes from investors to secure it against the house while we're renovating it and getting it resold. There's other notes that are where we'll loan money out for the same people that are doing that, and then we can do what's called an hypothecation and do that and secure other money against our note that we've lent. In a seller financing strategy, it's actually a great tool to add to your tool belt of real estate investing, where it's another way to sell a property. So what you're typically doing in a situation when you're doing seller financing is you have a buyer, maybe they can't get financing. We do this to international clients that live in Japan, or self-directed retirement accounts, for example, that can't necessarily get traditional U.S. financing. And so what we do is we'll sell a property with seller financing in place. We'll make them put a down payment down, and then we'll carry paper. And when we do that, when we carry paper, we're saying, hey, buyer of our property, we will sell you the property for X price, and we will allow you to put this much money down, and we'll loan you the rest for a certain interest rate for a certain period of time, and then that note gets secured by the property, and you're protected because you vetted that borrower, and you also have the right loan to value on that property, meaning you have enough collateral in the property to be able to resell that property and get all your money back. And that's your protection involved in that scenario. So for me, if I'm going through, for example, and selling a $200,000 house that I'm into for $150,000, and I have a buyer that comes in and wants to go put, call it 30% down, which is $60,000 on a $200,000 house, then what's happening is they buy it for $200,000, they put $60,000 down, and I loan them $140,000. Now, maybe I loan it to them at a 7% interest rate or something along those lines, because it's private money. It's not bank money at the 4 or 5% rates. And so, but in reality, what is my risk here? So I sold a house for $200,000, and I gave them a loan for $140,000, okay, which is basically 70% of the market value. So if the property sells, or if that person doesn't pay my mortgage for $140,000, it doesn't pay per the agreed contract, I can now foreclose on that property and go resell it for the $200,000 that it's worth and get all my money back and then some as well. And so when I do seller financing, it's even better, because if I'm into that property for $150,000 on my flip, and I'm getting $60,000 down, after that, I'm really into it for $90,000 to $100,000 after closing costs and commissions and things like that. And my loan is $140,000. So if I'm into it for $100,000 now on a $200,000 property, really my loan to value is not 70%. My loan to value is on my cost is 50%. So I'm even in a safer position. So that's why I'm willing to do seller financing to different investors that, maybe can't get traditional U.S. financing, but still want to invest in real estate in multiple ways.
Exactly. And just want to touch on that just so everyone's on the same page there. So when he says that he provides him a loan, he provides the buyer a loan, he doesn't actually wire them the additional $140,000. He is playing the role of the bank, meaning that the buyer has put down the down payment of 30% and now is paying him, OCG Properties or Matthew Owens is paying him the monthly mortgage. Now, in the event that he defaults, he can take back that property. I just didn't want to get the impression that he's actually giving them money. He's giving them the house, and he is actually the one providing the financing. But I think the key there is that once this is completed, you then have this instrument. So you have this IOU, which can be sold. So talk us a little bit through about how you can potentially then exit the rest of that note by selling to a potential investor.
Okay. And this is where the paperwork comes in very handy, and understanding this paperwork and what makes a sellable note in the first place. Okay. And so, anybody can loan somebody money secured against a property, and that comes with a promissory note and a deed of trust. But unless you do the paperwork correctly, it becomes very difficult to then go sell that paper off. So there's an entire market out there for people that just want to buy promissory notes. They want to buy payment streams. I don't know about you guys, but I know a lot of people that if I went and lent somebody money at 7% for a 5 or 10 year term or something along those lines, and and someone else may be interested in buying that paper from me and buying that payment stream from me and making the 7% interest on their money instead of putting it into a CD and making 1% or something like that. And so there's also higher interest type loans out there as well where you can make 10% plus, but those are more active type deals where they might have a little bit of hair on them. Now, if I'm going to go, so what I do is I'll go sell a property, carry the paper, being the bank on that property, and now I have a promissory note. I own an asset that now can be freely sold to another party, okay? And in doing so, when you're selling that note to someone else, you have to go transfer, if they're going to buy it from you, you have to transfer the ownership of that note to them, as well as the collateral and security interest in the deed of trust to protect their money. And so typically what happens when you're selling a promissory note is you enter a promissory note purchase agreement, just like a property purchase agreement. And then it says, I'm going to buy it for this price. This is the current balance of the note. And whatever stipulations you have in a typical promissory note purchase agreement, okay? Then the way you assign that note the way you close escrow on it, you can do it through an escrow company. You don't have to necessarily, but what you do is you sign the back of the original promissory note. It's called an allonge, which you actually sign the back, which is basically saying I am giving this ownership of this promissory note to this new person. In addition to that, you do what's called an assignment of deed of trust, meaning I already have a deed of trust that's secured by the property at the recorder's office, and I give my investor, if they're buying it from me, an assignment of that deed of trust, which basically says I am giving you ownership of my deed of trust that secures my interest in that property and against that property. And so what's happening is by an assignment, you're assigning the ownership and the collateral interest in that note over to the new person. And in order to do that, in order to actually successfully sell the note, there's also some backup documents. In addition to the promissory note and the deed of trust and the assignment of deed of trust, you also want to go and get all the borrower information, for example, the 1003 loan application. You want to make sure that you have proper lender's title insurance. Everybody knows about owner's title insurance, where, when you buy a property, you get title insurance. So that way, if there's a lien that shows up on title after you own it, then you are covered by the title insurance. But a lender wants to be covered as well. So they can typically add on a lender's title insurance policy onto any time you put a loan on a property. In addition to that, you want to make sure that you are put as the loss payee on that insurance policy as well. So whatever you're lending money to somebody, if they have liability insurance and fire insurance and things like that, you can go put yourself as the lender as the loss payee, which means that if there's a peril, something happens to the property where it burns down, you get paid first on the insurance claim to pay off the loan before that occurs. And so, what we do is we go through and get all of this stuff up front taken care of with driver's license copies, the 1003 loan applications, we get the tax returns, we get the pay stubs, we get everything a typical lender would require of you if you're getting a loan from a normal Fannie Mae, Freddie Mac lender, on a house. And that way you have a complete collateral file in order to sell that note to somebody else and successfully do that. And it's much more stringent when you're dealing with selling these notes to banks or other professional lenders. They want to have a complete collateral file in order to buy that property, that note from you.
Yeah. Wow. That's a lot of really good information. Definitely something we'll have to listen to a couple times, but that's the kind of thing that you have to have all these items in place. This is why I like working with teams that already have a system in place to acquire all that. And they have already, have a checklist that they're going to get each document, because the reality is one of the beauties of buying an instrument like this is that you can actually sell it. And so in order to be able to sell it though, you need to have those documents in place. Now earlier you touched on potentially selling or actually selling a property with seller financing. Let's say you sold the property at a 7% interest rate. Now, the key is that these are private transactions. So when you go to sell the note, you don't necessarily have to sell it for the amount of money that you loaned to the person. So what this means is that you can actually sell it at a discount, and that will actually increase that buyer's ROI. So for example, if you have a note that you purchased for $30,000 or essentially purchased for $30,000, you may go sell that note for $28,000, and that interest rate that the note buyer is going to receive will be higher than the interest rate of the note because they're buying that note at a discount. And this is what makes notes really interesting, because that way the seller financing structure allows you to sell a property to a buyer that may not have access to traditional financing. But then you don't have to necessarily hold that note. So you can very quickly sell that note to a discount to a note buyer. And then all of a sudden you've made a transaction which was completely impossible if you did not have this whole structure, this whole seller financing, this whole network of note buyers in place. So this completely change a single family person's business if you're able to implement these structures. And there's still a lot of real estate agents out there that are not effectively marketing this. So hopefully they're taking a listen right now. Now, kind of jumping around, would you consider hard money loans? Would you consider those notes? I mean, is that, when you think of notes, is that something that you think of?
Absolutely. So it's
Okay.
basically a promissory note secured by property in a different fashion. So, there's seller financed property, promissory notes where you actually own the property, sell it, and provide financing as the bank as well. There's promissory notes that are actually specifically loaned for someone else to purchase a property that you don't own to go flip it. So I borrow funds, for example, from investors when I'm flipping a property and secure their money by my property and then go resell the property and then pay them off afterwards as well. That's typically considered a private loan or a hard money loan. The only reason they call it hard money is when it's a very high interest rate, because it's hard to make a profit off of a high interest rate loan. And so so in these types of situations, when you're dealing with the different lingo, all hard money loans are private loans, and typically they have a little bit more interest rate or a little bit higher interest rate, or they're done by professional lenders. Now, when you're dealing with hard money loans and professional lenders, sometimes it's worth paying the higher interest rate because you don't have to deal with the headache of raising the money yourself from a bunch of smaller private lenders that may not be in the business of investing in notes. And so you have a lot more education that you have to put in and time that you have to teach other people how the promissory note structures work and how they're protected and things like that, while a professional lender that what you would normally consider a hard money loan may have a lot of different advantages, meaning deep pockets with backup. For 100% certainty that if they say that they're going to fund, they are going to fund, assuming you are working with a credible hard money lender in the first place. And even though it might be a higher interest rate, that money will much more reliably be there versus some private investor that could back out on you in the last second because it's new doing business with that person or something along those lines. And so I think it's important to understand the differences. Sometimes it's worth it. In addition to that, these professional lenders, if you go to them with a deal that really doesn't make sense and you shouldn't be buying it, they will tell you don't buy it because you're not going to make money on it. And if they're not going to be willing to lend you the money in the first place, then maybe you shouldn't be buying it because the risk is too great for them, even though they're at a lower loan to value than you're going to be when you flip a house or something along those lines. And so, heed the warning from these professional lenders if they don't want to lend you the money because they have a lot of experience analyzing deal after deal after deal to make sure they know what the good ones are and what the bad ones are.
Yeah, good point. What are you seeing in terms of interest rates for, let's start with hard money loans, for 12-month hard money loan? What are you typically seeing for interest rates in the markets you're working in?
So it depends on the sophistication of the investor. It depends on how much experience that investor has in the first place. So I raise a lot of capital at 6 to 8% interest rates because I've been doing this for 10 years. I have a very long track record of doing this, and I have I basically have a very large relationship base where I've developed a lot of lenders over a long period of time, over the last 10 years. And, this is back to the networking thing where you get all of your private lenders is through networking. In the beginning, right when the market crashed, I was doing nothing but going out to all of these different private lenders and basically and going to tons of networking events to find more and more of these private lenders that I could work with, and that was huge for my resources and being able to buy more properties. Now, that's why I'm able to charge 6 to 8% rates in a lot of instances. Now, there's some clients that come in with $500,000 or $1 million or something like that, and then they might get 9 or 10% rates because they're bringing more value to the table. And they can fund more quickly, more faster than a lot of other people, and more streamlined. Now, if you're a new investor and you're just getting started, you might be in the 10 or 12% range with a couple of points involved or something like that because you don't have a lot of experience, and so the lenders are looking at you as more risk. There is hard money lenders out there that will lend to you at 8 to 8.5% interest rates with a couple of points as well. But a lot of them start off and tell you those rates, but then you start to get involved in talking with them, and if you don't have the experience, they'll be in the 10 to 12% range as well. So I would say hard money lenders, and the rate you get depends on the sophistication of your borrower and how much resources they have. And you're taking less risk when you work with someone that has more experience. So that's really where that rate difference comes in.
Totally. Makes total sense there. What about the rates for long-term notes? Let's say there's a note for a seller financing property that you just created. Let's say you create the note at 6 or 7%. When you sell to an end buyer, where are the interest rates going to be on more of a long-term note? Let's say 5, 6, 7, 15 years.
Okay, so it depends on the investor involved again, but and it depends on the loan to value. If you're doing a 90% loan to value, your rate better be higher in the 10% plus range. But if you're like, I have some notes that are 30% loan to value, in which case, I have them at 7% interest rates, and I can get 7% if I sold that note because the loan to value is so low. The risk is so low on that investment type for a long-term type investment. But so it's all across the board when it comes to the note types and things like that. So the rates vary dramatically based on what you're investing in the first place. Like, for example, if I'm investing in something that's a longer term type deal, but it's non-performing already, meaning the borrower is not paying, you can buy that type of paper and those types of notes from other people and make 14, 15, 20% on your money, but it's very active as well, meaning you have to go foreclose on the property, you have to go or you have to go and try to get them reperforming and jump through a lot of hoops to get to your 20% rate. It's a very active type investment. A lot of people can make really high returns on notes, but it depends on how active they have to be in as far as the work goes. So you have to kind of compare, is something going to be performing and passive where I don't have to do any work, versus if I have to do work, then I better get a higher interest rate on my money to compensate me for my time. And so those are kind of the scenarios that you're looking at whenever you're buying any kind of long-term paper there. So as well as the loan to value associated with the note versus the value of the property that is the collateral for that note in the first place.
Totally. Again, just because of the flexibility of notes, because of the fact that they're just really private transactions, there's a really interesting situation that can take place with the risk return profile. So when I first started looking at real estate transactions, it was clear that generally speaking, the higher the risk, the higher return. But sometimes with notes in particular, you can actually have that invert in this really interesting way. So let's say, for example, that you're buying a note that provides you with $300 a month in cash flow, and you're buying this for $40,000, and the property value is $100,000. So you're buying a note at a 40% LTV, very low LTV, and it's going to give you this return. Now, the interesting thing is, if you actually bought that same note for less, the return would be higher, but also your risk would be higher. So let's say, for example, you only buy the note instead of paying.
Your risk would be lower in that case.
Oh, excuse me. Yes, sorry about that. I misspoke there. So let's say, for example, you're buying the note. Instead of buying it for $40,000, you buy it for $35,000. Now the LTV is 35%, but because the payments are the same, your return would increase, but your risk would actually decrease. So you can do a lot of crazy stuff with notes that maybe doesn't make as much sense as typical real estate investments, but just because of the fact that they're flexible and they're basically liquid instruments, you can kind of make things like that happen. One thing I wanted to talk about as well, which is part of that discussion as well, is the difference between amortizing and non-amortizing notes. So let's talk about, you just explain briefly what the difference between those two is, and we'll kind of jump into the details of each.
Okay, so there's a bunch of different notes that are available out there. There's notes that have balloon payments at the end of a term, like 5 or 10 years or 1 year. And then there's amortizing payments as well. That so there's interest only payments and then also amortizing payments. So interest only means you borrow $100,000 note and you're paying 8%. You're paying 8% on that note, or you're getting 8% on the note. You're making $667 a month every month. And maybe you have a balloon of 1 year. And so therefore, after you continue to pay the $667 a month for 1 year, you have to pay the entire $100,000 back. And you are still having to pay the exact original principal back because it's an interest-only loan. You're not paying down any of the principal of the $100,000. In most mortgages or long-term mortgages, you have an amortization where you might be paying it off over 15 years or over 30 years or even 10 or 5 years in a lot of cases, depending on the note. And so what's happening is in those payments, you're getting a portion of interest and a portion of principal back. And you can still make a very high interest rate on those as well, as far as amortizing notes goes. Does that make sense?
Yeah, absolutely. And I think that, one of the things to consider if you are investing in notes, particularly if you're investing in amortizing notes, let's say you get a 15-year amortizing note that pays itself down. Now, if you're getting $350 a month from that note, you need to be cautious that if you spend that entire $350 a month on purchase items or expenses, at the end of the term, you're not going to have any principal. So you're basically spending your own money. It's not all profit. But if you're having a interest-only note, let's say like Matt's example, and you're getting, let's say $600 or $6,000 a month or so, $6,000 a year. If it's interest only, at the end of the term, you get your principal back. So just something to keep in mind if you're talking about this from a financial planning perspective. Don't spend all of the cash flow from amortizing notes because you're just spending your own money or partially spending your own money. Does that make sense?
Right. I think it's important to make sure that when you buy an amortizing note, that you look at your amortization schedule and continue to put the principal aside, because that's your original principal. That's not your interest as well. So a lot of people don't realize that, and they start, like you said, taking all the money, and that's part of their original principal balance too. So you want to be careful not to make sure that you know what part is profit and what part is not.
Yeah, good point. And then also with amortizing notes, the fact that you're getting some of your own money back, you're going to experience a higher cash on cash return than the interest rate. So for some people, getting their own money back faster is a good way to mitigate risk. So kind of having a combination of equity investments in real estate, having notes, and then within the note sector, having a combination of interest only notes and amortizing notes, you're starting to build a really solid portfolio. And I think that that's, key for any kind of real estate investor to utilize all these tools together. Generally speaking, what markets do you think the note game works best in?
So what markets? Meaning,
what geographic locations, what cities, metropolitan areas, et cetera?
I think this works nationwide, but I think the biggest trick with this is understanding the risk profile. So when you're investing in promissory notes, a lot of people, and this is a common saying that people say, is you have to be happy with the investment if they are paying you on your promissory note, or if they default and you have to take the property back, you have to be happy with the investment then as well. Meaning you're going to make enough money if you have to foreclose on the property and take it back for your collateral interest to have that make sense. So if you deal with certain markets that have very low price point properties like $15,000, $20,000, $50,000 or less type properties, or even up to 75 or less sometimes, you could be in a situation where if you had to foreclose, you really don't want that property in the first place. And so I would suggest being careful about the areas and neighborhoods that you invest in, because, what if you bought something in the hood somewhere and you don't even want to go into that neighborhood, if they don't pay you? So what are you going to do if they don't pay you? And what is your collateral involved there? So it really has to do much more with the collateral aspects than the specific market. So one part of multiple markets around the country is those lower end asset classes that I would stay away from and steer clear from, just because you don't really want the asset back afterwards. The other aspect to make sure of when you're investing in different markets is how volatile is that specific market for a downturn to occur. Like right now, we've seen a major run up in most real estate classes across the U.S. And so if you were to do a promissory note in a market like California, and say my limit is 75% of the market value of that property, and I will not loan above that value, okay? In a market like Tennessee, where I invest, or some of the other Midwest markets like Atlanta or Indianapolis and some of these other ones, when there's a market correction, don't have major volatility. You might have a 5%, or in some markets a 10% swing. But if your note currently is at 75% of the market value in those markets, and it goes down by 10%, maybe you're at 85% of the value, or 80% of the value, and you're still in a safe position to be able to go and take that property back and resell it if you had to. But if you're in a market like Riverside, California, that can go down by 25 or 30%, then you may be wanting to limit your loan to value a little bit more, because, say you have a $100,000 house in Riverside, and your loan is at $75,000, which is 75% loan to value, and the market drops and it goes from a $100,000 property down to a $75,000 property, which is a 25% drop, and you're at 100% loan to value. What happens in that case? If you have to take that property back, not only do you have foreclosure legal costs, which can be, call it $5,000 or something along those lines, but you also have realtor commissions and possible repair costs and things like that, that then if you were to sell that property, you may not get all your money back on the actual investment. So the market is important in that regard, as it relates to, the volatility in the market and your risk level associated with how high of a percentage of loan you're going to give compared to the value of the property, as well as, buying properties that you may not necessarily want to own afterwards if there is a default. Does that make
Totally.
sense?
Yeah, absolutely. And I mean, you mentioned some really low loan to value notes earlier, and you're just trying to think of it on a risk profile basis. Those notes, like Memphis, for example, Memphis hasn't experienced a 30% correction, not in any data that I've ever seen over any time period.
Right.
And so if you're looking at a note that is 50% LTV, there would have to be a correction so significant, unlike any that it's seen, at least in certain price points,
Right.
that just to get break even if foreclosure takes place. Now, of course, there are a million different things that can happen that can devalue the property unrelated to the market, and those are things you have to control for, particularly on the management side, tenant selection, etc. But on a risk-adjusted basis, these are some of my favorite instruments, and some of the first investments I ever made because of that, because of the simplicity, because of the protection, because of the collateral in place, particularly in these low volatility markets. Speaking of the potential drawbacks of debt, can you think of any drawbacks of utilizing these investment vehicles or investing in debt as a whole?
There's a few. First, it's analyzing the risk level involved in each in particular note. Okay, so if your risks are a market correction, then stopping you from getting 100% of your money back, which you may get a percentage or a very large percentage if you're investing correctly. Your risks are the operator involved. Are they going to be difficult and trying to stop you from foreclosing and things like that? Your risks are, which I think investing with the right operator can mitigate 90% of the risks associated with investing in most investments in the first place. And in addition to that, you have repair issues where, if a property is in total disarray and someone never rehabs a property, then you have to put that money back into the property. Now, most of my rehabs in Tennessee are 30 grand, 40,000 bucks. And so if I go through and buy a $150,000 house and I have to go and put $40,000 into it, then I want to make sure my loan to value is low enough to where I know that isn't going to be a problem. In addition to that, I would be careful about really, really long-term notes because they're not inflation adjusted. So there's positives and negatives, right? So the issue is we all know we have inflation on an annual basis, but if you have a really long-term note, then your actual monthly payment stays the same over the long term. So the purchasing power of that note declines over time. Okay. Now that's kind of opposite than a property in itself, where that typically goes up with inflation, as well as the rents typically go up with inflation if you own actual property. So I would consider a combination between owning real property that is an inflation hedge and owning promissory notes, and not going too long term. Like 30-year notes are tough to deal with because, what is that payment really going to be worth in 30 years? If you're getting a $500 a month payment in 30 years, that's going to feel like $10 a month or $15 a month, right? So, or maybe $100 a month. I don't know. I'm being, I don't know how much they're actually going to print. We'll see. But I'm a little skeptical in my own mind about that. But then again, in a promissory note scenario, you have the luxury of having set consistent monthly payments every single month. But in a property investment, you may have a vacancy, you may have a repair that you have to cover. It may not be as consistent of cash flow as a promissory note involves. So there's pros and cons to each, and I believe a proper portfolio should have a number of different investments within it so that you have some of that diversification for inflation hedges, stability and consistency of monthly payments, and things like that as well.
Man, you touched on a lot of things. I think that's a great answer to that question. And just to kind of, add some further color to the discussion about inflation, notes make a great deflation hedge, right? Because if the value of the dollar for some reason increases, let's say prices collapse virtually across the board, then those same payments are actually worth more. Now, the reality is, historically speaking, deflationary periods don't last very long, but at least I thought I'd just add it to the conversation, since it does paint the picture of really building a fully diversified portfolio when you do this. Additionally, one of the benefits of investing in real estate is there's a lot of tax incentives for doing so. When you invest in notes, because you're not owning actual hard assets, because you're not owning equity in real estate, you don't get as many tax advantages. You don't get the tax advantages of investing in real estate. However, notes can make great Roth IRA or any kind of self-directed retirement plan investments because of the fact that they're very passive. If you structure them correctly, they can be very low risk. And because of the fact that these items are either tax deferred or tax free, you don't have to worry as much about the tax incentives. So, overall, starting to paint the picture of really a critical tool when building a portfolio. So one last question, Matt, and I definitely want to get your perspective on this. Where do you see the major opportunities right now in the real estate space?
The major opportunities. I mean, it has to do with technology, in my opinion. So as technology continues to improve, it enables people to come up with new strategies and tools and techniques to be able to increase efficiency of most real estate investments. And so, when I look at opportunity, I see opportunity everywhere, not just in real estate, but everywhere that you look as far as income opportunities that exist. And I think the more you invest in your education and learning different real estate strategies, the more money you will make long term. Like, for example, we're doing a short-term rental business right now that is a huge opportunity and a very, very high return on investment, but it's also very labor intensive. And so in order to make that strategy work, because really I'm just getting paid for my time right now, it's to set up systems and technologies and tools, which are actually pretty plentiful right now, to be able to structure things so that you don't have to do the work for it. And so in my opinion, it comes down to looking at different strategies and then saying, okay, what is going to make sense right now? Like I'm going through and doing that short-term rental business where I'm subleasing property off from other investors and that want to hold rental properties, and they're really happy with that strategy because they get consistent rent from a corporate client. They have a number of different positive attributes to it. And I'm flipping houses, for example, right now, which the margins are thinner and thinner as the market gets tighter and tighter and there's more competition. However, I have a very good system now where now I'm developing a property. I have a full property management business that we're running that has income coming in from real estate. We have a note business right now where we're doing a lot of private lending where I can exponentially increase my returns on notes by utilizing outside people's capital. And so when I say adding different tools to your tool belt, I'm talking specifically about understanding these different strategies and how to protect investors so you can make money. For example, I went through and I just lent $225,000 at a 12% and 1 point interest rate to a newer investor that doesn't have a lot of capital sources, but at the same time, I'm looking at like a 65% loan to value, so I'm in a very safe position there, and I have all contacts for all the team members if I needed to step in and help. Now, I borrowed $175,000 of my 225 at an 8% interest rate from a private investor. Okay. Now this is a 1-year loan or a 6-month loan, so I get my 12% in my point, and I'm paying off 8% on the 175. So if you do the math, as far as a return on investment on my 50,000 that's left in the deal, instead of and I borrowed the 175, then I'm making a 35% return on investment on my $50,000 by doing that strategy. And but in order for me to do that strategy, which is a gigantic positive play to be able to really ramp up your returns, I had to learn in detail how to protect my investor every step of the way to make sure that they weren't going to lose their money, involved in these transactions. And I'm putting my money where my mouth is and having money in the deal myself too. And so I think the opportunity comes in play. I think opportunity is everywhere in every market that we're dealing with, and it comes down to your education on strategies to be able to implement those opportunities. Like right now may not be the best time in California, for example, where we had a major run up in pricing to go through and buy a property, a single family home or something, or a multifamily to hold long term because the interest rates are so low. However, what if because we know rents are rising so quickly, what if you were able to go get a 5-year lease and sublease it and have the ability to sublease and then go release it to somebody else for a couple $100 more? Now you're not taking the risk associated with the property in itself, knowing you're buying it at the wrong time in California because California has major swings, and you're able to take advantage of higher rental increases and faster rental increases where you can slowly increase rents and increase that spread over time too. So there's different strategies associated with different markets that you're in around the U.S. as well as overall U.S. as well. So does that make sense?
Hell yeah, it makes sense. That was an awesome answer. And it's very interesting to hear how you're able to leverage, basically your existing track record, your existing network, and then your own knowledge about real estate to kind of achieve those type of returns. So Matt, really, thank you so much for your time. Really enjoyed this conversation. Thanks a lot.
No problem.
For all the listeners out there, thank you very much for taking the time to check out this episode today. If you'd like to get in touch with Matthew directly, feel free to go to ocgproperties.org. They have a contact form, and Matt or someone on his team will get back to you pretty quickly. And again, don't forget to leave us an iTunes review. It is much, much, much appreciated. Thanks a lot.